Hi again. Okay, I'm wrapping up our Chapter 9 discussion on budgeted income statements. Okay, I talked about the cash flow. I'm not holding you responsible for it, but I am going to give you permission. By the way, pardon my appearance, but it's really, really hot in here. It's a beautiful day today, and if I run my air conditioner, you won't be able to hear me over the roar it makes. So, anyway, I am offering you the chance to keep this if you decide to sell this book to anyone in the future who is taking this course at Dean College, and you would like to copy this chapter. I encourage you to do it. I will not be upset. Don't tell my publisher I said that. But you have my permission to copy Chapter 9, only Chapter 9 please. And if for any reason you find that you need some of these materials in the future and you have not kept them, write to me and I will actually send you the materials directly at no charge, okay? So we are talking about the budgeted income statement. I won't ask you to prepare one, but it's very vital that you understand what goes into one, because this is the culmination of most of what we've done so far in Chapter 9. Now, in a budgeted, in any income statement, we know that it begins with sales. Now, we follow that with cost of goods sold, because when you sell something, you have to reflect its cost, and the difference between the two is what we call, in the wonderful world of accounting, gross margin or gross profit. Okay? Then we deduct any period costs, in this case, selling and administrative, and then you subtotal that. That is called operating income. Then you pull out interest expense, if any. You get that from the cash flow statement. And then you have pre-tax income as a subtotal. You subtract any income taxes, and that gives you your net profit. Now, that's what an income statement looks like. Okay, so we're going to go through the elements and see where they come from. Ladies and gentlemen, this is a budgeted income statement. Okay, sales, first of all. Where did that number come from? 7574, okay? That number came from your sales budget. I refer you back to page 237. So go to the, this is an assembly. All the heavy lifting at this point is done. All you're doing is going back and capturing data from things we've already done in previous steps. Page 237, you'll find the sales budget, 7574, also by quarter, and there it is right there. Secondly, whenever you sell something, you have to match a cost of goods sold against it. Now, we sold our goods, a certain number of units, for $7 each. Back when we analyzed direct materials, direct labor, and overhead, we found that our total costs per unit, looking at our manufacturing cost profile on page 245, after we did direct material, direct labor, and overhead, was $4.41. Easy. Take the number of units from the sales budget. That is the cost we have to match. Take that number of units times $4.41, and that's where we get that line that says cost of goods sold. The cost must follow the sale. Okay? We subtract one from the other and get gross margin, as you'll recall. Okay, that is just a subtotal. All right, then we grab our selling and administrative expenses. Go back to your selling and admin budget, page 247. Don't grab the green number this time. This is not a cash flow. This time we're following GAAP to do an income statement. So the yellow number is the one you want, and that is $1,228,000 for the year, again broken out by quarter. Subtotal, income from operations. Okay? Interest income, where did that come from? Well, I gave that to you. Look back at the assumptions that you will see on page 247 and 248. That's where that number comes from. Obviously, we have money invested somewhere, and it's generating income for us as an aside, outside of our normal operations. Interest expense. Okay? When we did our budgeted statement of cash flow, we saw that we had interest on a note payable. This is on page 252. I gave you this number. All you have to do is put it in the right place. Okay? But interest income is a cash flow item. It is also an income statement item because it is the cost of credit. That's, as we already know, that's what interest is. All right, so outside of our normal operations, those are all of our incidentals. We call them other. Subtotal, income before tax, And back in our assumptions on pages I cited before, page 247 and 248, I told you income tax expense was $145,000 per quarter. That gives us net income, as you can see, of $920,900 budgeted for the year. All right, that pretty much brings us to the end of my course. If you would like to look in to this next section, the budgeted balance sheet, friends, by the time you've done your income statement, by the time you've done your cash flow, and if you start with a balanced balance sheet at the start of the year, the end of your balance sheet solves itself. There's very, very little challenge there. If, on the other hand, you can't make it balanced, then do me a favor. Drop me a note. I'll be happy to explain it to you and provide any supplementary examples that you would like to see. Okay? Now that is it for Chapter 9. Please remember, I'm only going to hold you, because of the late point in our semester here, I'm only going to hold you responsible for the preliminary elements and concepts going into budgeting with a focus on the elements of the income statement. Okay? But a budgeted set of statements is very comprehensive, and I hope that I've done an adequate job in Chapter 9 for you. And I thank you very much for your kind attention throughout all of these video lectures. I'm going to wish you at this point the very best of luck in wrapping up our semester and good performance that I've come to expect from you in our final exam. Have a great summer. Bye-bye now.